Okay, welcome to quantitative easing. It's actually quite a complex topic, but what we're going to do is go through it very basically at the start. Now look at this cartoon. This indicates that the Bank of England tried quantitative easing and they weren't too sure exactly what was happening, hence the crossed fingers. Anyhow, nice glass of water here, keep a clear head, off we go. Quantitative easing was introduced in 2009 by the Bank of England. It's also been used in the Bank of Japan, something similar, and of course it was introduced in the United States as well at a similar time. And of course, as a consequence of the credit crunch, which occurred in 2008, we had this enormous recession, and the Bank of England was basically running out of monetary policy tools. Its used interest rates were reduced to 0.5%, the lowest since 1694. That's the bank's bank rate. And fiscal policy was perhaps a busted flush because our national debt had risen to sort of quite a high level. So the bank was left really looking for alternatives, and it hit upon this, what was generally known as an unconventional policy measure, which is known as quantitative easing. Well, the posh word for it is the asset purchase scheme. And the Bank of England injected £375 billion into the UK economy from 2009. This was in the form of electronic cash, and electronic cash was then given to banks, okay, that increased the bank's sort of liquid assets in exchange for bonds. That's all quantitative easing is. So basically its effect on the economy is this, that the Bank of England would increase the money supply, which means that banks are then able to lend out and encouraged to lend out more to consumers and to businesses, and therefore increasing consumption and investment, and therefore leading to an increase in aggregate demand and hopefully some form of recovery from the recession. Now that's quantitative easing in a nutshell. A more complex, more realistic approach to quantitative easing is this. So this is the more complex approach. Basically the bank, this is the bank's balance sheet here. The Bank of England injected more or less £375 billion worth of cash in the form of liquid assets. Liquid assets are those which have immediate purchasing power. So banks always like to keep a certain level of liquid assets to be safe. Okay? Sometimes it's been a bit too low. And these were given to banks in exchange for bonds. So bonds come the other way. Now of course what happens is if you buy lots of bonds, the demand for bonds increase, bond prices increase, and the yield on bonds, the interest rate on bonds would fall. So long-term interest rates on bonds started to fall. It's estimated they fell by 1%. So that meant the bank thought, what are we going to do to make profit? Okay, so other investments for the bank on the balance sheet, so the bank put greater resources into mortgages, into shares, and into loans, advances given to firms and individuals. So as a consequence, these parts of the balance sheet offer a greater rate of return compared to bonds whose interest rate had fallen. So the bank therefore, in theory, the banks would expand the mortgages and the shares and the loans advances given out. The loans advances meant there was more lending, often to businesses which would increase investment. Greater shares meant the stock market went up and the share prices increased considerably, perhaps as a result of quantitative easing, and so did house prices begin to recover as a result of more mortgages given out. And therefore that leads, of course, as you know, to a positive net wealth effect, which leads to an increase in consumption in the economy. Of course, another thing that people don't mention at all is the Bank of England actually bought good quality corporate debt. These are basically long-term corporate bonds. That eased the corporate bond market and enabled more investment to take place by larger corporations. So there's really three ways in which quantitative easing affects the economy initially. First of all, through the process described by reducing bond yields, which encourages banks to change their balance sheet and have more mortgages, shares and loans. Secondly, of course, it provides extra liquidity. So this electronic cash is increasing the amount of liquid assets the bank has. This enables and encourages banks, again, to lend out more. And perhaps the third factor, and the third method in which quantitative easing has an effect, is perhaps the most significant. Martin Wheel, who's an economist who used to be on the MPC, argues that the signalling channel effect was perhaps particularly significant. And what happens is that the Bank of England, by undertaking quantitative easing to such a large extent, signals to the market that it's going to have a reflationary monetary policy for an extended period of time. And this boosts business confidence and it reduces uncertainty in the stock market and in financial markets. So those are the three key areas here in which quantitative easing has an effect. Now, what are the pros and cons? Economists, again, are somewhat divided by quantitative easing. Some are deeply hostile to quantitative easing, as are some commentators, particularly in the United States. But let's look at the pros and cons. First of all, it might be important to state that quantitative easing 1, QE1, seemed to have a bigger impact than QE2 and 3. Perhaps because when QE1 was undertaken, markets were more dysfunctional, the financial markets were more dysfunctional, therefore it had a greater impact. The second thing to say is, of course, quantitative easing seems to have a greater impact in the United States, to an extent, compared to the UK. However, Martin Wheel, who undertook independent academic research into quantitative easing, argues that it had a significant effect on output and inflation. Because what happened is, you could argue, many would argue, that it prevented a huge full-scale depression, rather like what occurred in the 1930s. Well, of course, remember the WTO and the maintenance of some sort of free trade maybe also played a role there. But another factor, of course, is preventing a lost decade of deflation, like what occurred in Japan. So Japan has had at least a decade, of course, of prolonged deflation with zero growth. And this was prevented as a result of deflation in the United States and in the UK, one could argue. The key thing is that, according to econometric research by the Bank of England, it boosted economic growth by 2.5%. Okay? It reduced the bond interest rates by 1%, and it boosted inflation by 1%. Therefore, it reduced unemployment and increased the standard of living. And these are significant macroeconomic developments which, of course, affect ordinary people in a positive way. The other factor is it reduced stock market volatility and certainly reduced uncertainty about the future path of interest rates. So these are significant pros. Now, the cons, you can evaluate these, but potentially it is hugely inflationary, because if you think of the money supply, we're injecting a quarter of our GDP into the economy. Maybe in normal times this could create a significant increase in inflation, and some historical people have worried about hyperinflation. Incidentally, don't get confused about an injection of electronic money into the economy. It's not printing money. It's not helicopter money where money is just given out to people. Okay, so the Daily Mail might say it's printing money, but strictly speaking, it's slightly more complex than that, as we've seen. Anyhow, potentially it could be hugely inflationary, but if you look at the velocity of circulation, it's actually very low, and a lot of that money has sat in bank accounts. If that changed, of course, quantitative easing could be reversed. And this comes to the next point. When quantitative easing is reversed by the Bank of England, and to the extent it's reversed, bond prices could actually collapse, some economists argue, because what happens is the Bank of England starts selling its bonds. Bond prices fall. What are you going to do if you hold bonds? Sell your bonds. So there'll be some fall in bond prices, and of course they're inversely proportional interest rates, so interest rates could skyrocket, according to some economists. However, the Bank of England doesn't actually need to sell its bonds. It could just let them reach maturity, which they will do over a 12-year period, or we could sell them gradually in a controlled fashion. Anyhow, there's some academic debate about this. A key problem, and one certainly mentioned in The Guardian, is it benefits the wealthy. The richest UK households' assets have increased by 322,000 as a result of quantitative easing. according to econometric studies. And shares and bonds have gone up 26%. So you can see what the positive net wealth effect varies there through shares. And 40% of the gain, of course, went to the richest 5% of households, who tend, of course, to hold much more wealth. The Bank of England would argue that it has benefited ordinary people who aren't wealthy because they have a job, because the economy is beginning to recover. So these factors are important even if it did benefit the wealthy. Another problem with quantitative easing, which is mentioned particularly perhaps in the Telegraphs and older readers, is that savers have suffered from ultra-low interest rates. So if you were a pensioner with a big pension pot, you're depending on the interest rate. Well, interest rates in real terms are often negative, okay, but it certainly had ultra-low interest rates. But again, the Bank of England would argue that if you've got a pot of shares, that the shares would have gone up in value. So whilst your earnings from bonds may have fallen, okay, your net wealth may have increased, because if you've got shares, the shares would have gone up in value. So that's something else to discuss. Other economists are talking about the currency wars, but this boosting of the money supply has reduced the value of the pound and has reduced the value of the dollar, and some competitor countries are somewhat concerned about this. Again, it's debatable because the pound, for example, recently has risen in value. Okay, so quantitative easing, in terms of exams, you really need to discuss its potential effects and evaluate what you consider as a policy, whether it's good or bad. At least we've got the pros and cons here. So I hope that was fun. Thank you.